Welcome, everyone. I'm really excited for this webinar series on, I'll call it M&A and really strategic partnerships, which lead into exits. And we have a really strong panel, right from someone who's built a company and gone through the ups and downs of that and exited successfully. And then, which I love, is taken that after a pause, a well-deserved one, and actually redeploy that capital, that experience into building more. And I think if you look in certain areas like Silicon Valley, that's so integral to how they sustain, they grow. And we're seeing that a lot in Vancouver. And thank you, BSA Tech, for your fostering and support for doing that. You know, we have Dan from the corporate finance at KPMG, brings a wealth of experience, and as well as Michael with a ton of transactions. So very excited for making a very collaborative discussion. If I look back, personally, I was with Deloitte for a dozen years. I led our corporate finance valuation group, so did a lot of advising on M&A transactions, sell side and buy side, internationally and based in BC. And then the last 25 years, I've been COO and CFO of public technology companies. Light AI is my sixth, and actually managed over 20 transactions. Some of them are small tuck-ins, buy-ins. Some of them are sale the whole company. And if I just have a couple framing points before we jump into it, it's interesting, a tech company, the life cycle, the early stage, validation, growth, scale. Do you stand alone? Can you become the next Google? Or do you actually partner strategically in that? And I think the real theme that I would like to highlight is build a great company. Focus on that, what you do, why it's important, who you do it for, and how you grow. The better you do that, the better your options are for doing something that's strategic, that is impactful. It may be financially oriented. It may be a complete exit, or it could be a partial exit, which really means it's a partnership, and 1 + 1 = 4, and you're really leveraging and diversifying. So, I think a lot of themes to really tap into. I think I'll kick it off with Kristine to first of all tell us a bit about your experience, especially with your transaction, and some of the companies you work with, and what you learned initially from that. And we'll go around the panel. But Kristine, over to you, and great to have you on our panel.
Great, thanks, George. I know Erica gave a little bit of an intro at the opening, but my name is Kristine. I was the CEO and founder of Alacadia. So we grew that company to around 130 people and exited to a private equity buyer in 2021, middle of 2021, which was like the height, I think, of exit time. So we'll talk about timing as one of the key considerations when you're looking at a transaction. We were selling to the CMO, so enterprise SaaS, and customers like Microsoft, Dell, Philips, Unilever, so hundreds of users. And the company continues. So it was sort of a kind of a merger, some acquisitions, and now the company's around 60, 70 million in ARR. So lots of people in Vancouver still working there, which I'm really proud of. It's fun to see that a bit, George, like you said, there's just an ecosystem that continues, and you sort of have these transactions, but it can continue to sort of invest in the community, especially in Vancouver. And yeah, now I've started a new company. I thought I would never do that when I was in the thick of Alacadia. But one thing I think I've learned about myself is that I do ultimately just love to build and to create, and just doing that again with actually some former executives of Alacadia who are now co-founders. So just talking about that cycle and continuing to invest back in the community, and just really excited about it. So yeah, I'm here to share experiences. Please, if there's questions, would love to hear from the group. So thank you.
Love that story, Kristine, and congratulations on success. I think that redeployment of capital, experience, and teamwork is really synergistic. And the nice thing I like about that, because I was with a company called Intrinsic for a long time. We sold to another public company, NASDAQ, called Lantronix. And the thing that was really, like you highlighted, it's great when you build almost your baby, your company, and you want to be protective of where it is. And it's wonderful when you create value, someone enhances that, leverages, and continues it. And so
Yeah,
that is
you can have multiple transactions. That was the whole purpose for going to sort of proactively do a transaction, was to take the company to the next level. And that's exactly what happened. And sometimes your own personal role as a founder it will certainly evolve through that, but you're sort of keeping the company strategy and company growth in mind, and doing what's needed to take it to the next level. So yeah, there's just lots of different ways about it, and you can continue to go. There probably will be another transaction of that company. I'd love to see that too. So yeah.
perfect. Well, thank you very much. Let's hear from Michael about his background and his experience, what he's seen in M&A and exit transactions.
Yeah, great. Thanks, George. Yeah, so my background in M&A, I've been working sort of in the corporate finance and M&A space for the better part of about 18 years, doing a broad range experience with both public and private company M&A in a range of sectors, all deal sizes and different structures, ranging from, billion-dollar transactions down to, smaller tuck-ins, distressed M&A and acqui-hire sort of scenarios. For the last decade of that or so, I've been largely focused on transactions in the technology and innovation space. Has been sort of and private company transactions in the technology and innovation space over that time period.
Well, and the other thing I'd highlight about being a legal and corporate finance advisor, but is you are very often a business partner and advisor in that process, right? So
Absolutely, yeah, and that's it. So I mean, often we're working for companies. I mean, sometimes we're buy side, sometimes we're sell side, but a lot of the times we are sell side and working with, companies that we've been working with right from the time they're incorporated, or sort of just getting themselves organized. And a big part of that process is, if you're working with sort of startups and early stage companies, is sort of helping them to develop that strategy and helping them think about M&A and where that fits into their company sort of in a holistic way, whether that's, when is the right time for them to look at possibly, on the other side of it, does it make sense for them to do some deals and do some acquisitions strategically to meet their growth objectives, or, alternatively, having the discussions with founders around, what do we do? And often that's prompted, with they're looking for a financing. Is sort of similar to Kristine's situation. It's, what is the best way to get this company to the next stage of growth? Is it really to seek strategic partnership through an M&A transaction by working with a private equity firm or another corporate strategic that can help to finance this and provide some experience and customers to really leverage this to the next stage of growth? Or is it going out and raising more rounds of capital to sort of build that and build out your team internally, right? And that's the place where a lot of founders, sort of struggle with the decision, because it is a tough decision, and there's a lot of factors that go into that for them in terms of which way they go with that.
yeah, there's certainly power in numbers, and probably very rewarding for you to see planting these seeds with early stage clients and
Absolutely.
grow. And
It
yeah,
is. I mean, those are some of the most rewarding transactions for me to work on, is the ones where you see the founders sort of make that growth from, forming the company through to that exit, and just, it's an emotional journey for them, and it's satisfying to be able to support them through that process.
no, okay, well, thank you for doing that so strongly for the community. And the other thing is not only to grow, but sometimes these strategic transactions are defensive as well, because you can
Absolutely.
mitigate risk by enhancing what you do, partnering as well. And Dan, I think you look at that in your M&A and corporate finance practice of how do you partner and really create 1+1=4, and something that's not just sustainable or scales, but much more, has much more sustainability to foster future growth.
Yeah, absolutely. No, maybe I'll give a little bit more background as well. And thank you all for attending the panel. Good morning. My name is Dan Gardiner. I'm a Senior Vice President in the KPMG Corporate Finance team here in Vancouver. I've been with the firm for the last 9 or so years, advising really private companies on buying businesses, raising capital via equity or debt, and hopefully eventually selling. One of the interesting things about BC is it's quite a diverse technology ecosystem. So I've had the pleasure of working with founders across a number of different end markets. One we've seen a ton of recent activity is financial technology. and payments. So we recently sold a company called Eigen to Shift4, which is a big US public company. Previously, we sold Nice Job to Paystone. Vancouver's always been a hub for media and video gaming. We worked with Scanline VFX on their sale to Netflix, Finger Food Studios on their sale to Unity, worked with Hothead Games on a few mobile title divestitures a couple of years ago, and then just a very broad swath of very focused vertical market SaaS businesses that we have the pleasure to work with. So I have a super fun job. I get to live vicariously through the true entrepreneurs like Kristine and George, and be a part of their exit story after all of those years and years of hard work becoming the overnight success story. So pleasure to be with you all, and looking forward to the conversation.
No, I love it, Dan. As having done that role with Deloitte for a dozen years, it's and then jumping in with the scariness of and the excitement of growing business. It's such a valuable partnership. And I will put a plug in. BC companies can buy companies too, and we can grow and stuff. So we don't always have to be the small fish. Sometimes we can grow and look at Clio as some of the big house companies in our backyard. But it's really in balancing what makes sense. And simply do want to explore that theme of some of the nuance of that. Do you partner? Do you buy? Do you sell? Do you grow? But I think let's talk about some of the top trends that we're seeing, particularly in the recent history. Kristine alluded to maybe a more frothy environment during COVID. And then we've got certainly macro and economic and capital markets challenges, but sometimes that creates opportunities. Dan, maybe you can start, because I know, and I'll put a plug in for KPMG, great firm, and you do a quarterly report that we'll put in the chat. But maybe you can start us off with what you're seeing today. What are some of the things that maybe buyers and partners are looking for? And then we'll go round the table on that one. But Dan?
Yeah, absolutely. So as George said, we put out a quarterly software market update that's really focused on North America, but there's more data about Canada. I find a lot of the data points out there are more US centric. So we tried to put together a report that's a little bit more focused on where we do work, which is with and for Canadian founders. So I'll rattle off kind of a handful of the key themes from our most recent Q1 report. So number one, capital raising remains challenging. Minority equity raise deal activity has remained quite depressed relative to the high watermark in 2021. So just for reference, trailing 12-month activity for Q1 2025 is down about 55% versus 2021. Again, that was quite an elevated level, but if you look back over the 10-year trend, we're still about 30% below kind of the trailing 10-year average. So I'd say early stage and growth equity deals are still challenging to get through. The silver lining, point two, is that the Canadian software M&A market has stayed relatively robust, despite all of the negative sentiment and general, sense of uncertainty out there. The trailing 12-month Q1 deal activity for private Canadian software companies is actually above the 10-year average. So I'd say from a capital raising perspective, tough at the early stages, but there's been an influx of different types of buyers for Canadian software businesses. And so exit activity has actually remained above the 10-year average. In terms of profitability versus revenue, we always have that trade-off. We track an index of 95 publicly traded software businesses. In the current market, profitability is expected. A few years ago, there was a premium, and we talked about, shifting the boat, trading off revenue in order to get to cash flow break even or get into the black or into the green. Today, 97% of public software companies are expected to become profitable in the next 12 months. About 70% have already made that pivot. So there's still a gap of folks trying to move their business to become profitable. A few years ago, we saw a valuation premium for those companies who had become profitable. Today, that valuation premium has dissipated. It's simply an expectation that you need to either be profitable or show a very short-term path to profitability. The trade-off then is on growth. So growth expectations have dampened. Only about 30% of public software companies are expected to grow above 50% over the next 12 months, which is quite low relative to, the bullish expectations for software revenue sales over the last 2 or 3 years. And for the first time in the last, 4 years since we've been putting together this report, there's actually a public expectation that some public companies will contract. So about 10% of publicly traded software companies, Wall Street analysts are actually forecasting revenue contractions for the first time in like 4 years. So that shows that, you know, from a sales and marketing perspective, sales cycles are longer for products, and the markets are adjusting to those expectations. Finally, the rule of 40 is really where folks kind of focus on that balanced trade-off between revenue growth and profitability. And achieving the rule of 40, although quite challenging, still will earn you a significant market premium. So if we look at our public company index, businesses that are beating the rule of 40 traded about 9 times forward revenue versus companies performing below the rule of 40 are trading about 4 times forward revenue. So almost a 200% premium for those companies, albeit fewer than in the past, who are able to achieve that rule of 40, predominantly driven by balanced growth and strong profitability.
That's a lot of data in a short time, but that's a lot of meat in the sandwich, but really important stuff, especially, I'm sure that we're going to have some questions about multiples. You talked about revenue, and then you talked about profitability. You haven't given us EBITDA multiples, but I don't want to put you on the spot. But, you know, maybe with that, why don't I throw, you know, Michael, what are you seeing that could augment, or what are your thoughts on some of the trends that Dan just highlighted?
Yeah, absolutely. I mean, I you know, anecdotally am seeing the same sorts of thing that Dan sort of mentioned. The data is showing, which is that there is, you know, still a fairly robust market for M&A in the software space. And talking to sort of other people involved in the other advisors in the deal space, that's what they're seeing as well. Is there is still strong demand for software M&A. I think, you know, in the current market, with some of the economic uncertainty that is out there, has been a bit of a fluid and changing market. I think people, you know, were quite bullish at the end of last year as to where the M&A market generally in Canada was going to go this year, and then there was a bit of, you know, pumping of the brakes early in the year people sort of got their you know, sort of got a sense of where things were going. And I think there is still some prevailing market uncertainty out there, but it's at a point where I think it's uncertainty that people are able to, you know, price in or structure around to sort of mitigate that risk. So in terms of, you know, the other trends that I'm seeing, you know, is that absolutely deal timelines are sort of dragging a little bit. Buyers, you know, are looking at lots of deals. You know, I see a trend towards them not moving particularly quickly. It was certainly not the pace that we were used to, and certainly not the pace that, you know, 2021, when everyone was moving as quickly as possible to get deals closed before somebody else came along to target the same target thereafter. But, you know, right now there is more due diligence happening, not just legal due diligence, but more business due diligence as well. And I'm certainly seeing timelines slip from what you would normally expect. You know, signed LOIs with, you know, a month of continuing business due diligence following before you're even starting to see legal due diligence or any work on transaction documents starting to kick off. So that's, you know, very unusual to what we would normally expect to see. But that is, you know, sort of reflective of buyers being, you know, very cautious still right now, and sort of, you know, time favors buyers in these sorts of transactions as they sort of try and mitigate risk. The other thing you're seeing, you know, in terms of risk mitigation strategies, is certainly increased popularity of things like earnouts, equity rollovers, as buyers are trying to put some of the economic uncertainty back to the sellers, you know, without having to trade off, you know, too much in terms of valuations, which, you know, generally multiples have been recovering a little bit from where they were over the last couple of years. So still seeing that, but you are seeing some hedging with equity rolls and earnouts, so that sellers are sharing some of that risk. You know, and I think strategically what that all means for, you know, if you're on the sell side in these sorts of transactions is you have to be prepared for it. You've got to be ready to sort of move as quickly as time permits, because it is, you know, there's a lot of uncertainty and noise out in the market, and that's sort of the other thing I would generally say to anyone that is involved in the M&A market at the moment is, you know, you sort of have to move quickly, because the market will shift. You know, the trends we're seeing right now could be very different by the end of this year. It's sort of, you know, it's all a little bit reminiscent of kind of as COVID hit and there was sort of market turmoil, and you know, what Q1 and Q2 looked like was wildly different than what you were seeing in Q3 and Q4 that year, and that could very likely be where we're at this year as well.
Great, great commentary to augment that, and a couple of thoughts on that. One is, don't drag your feet,
Yeah.
and capitalize it. You never know when it's, when something better, or it may come again, even if it does. It comes into something common in the market, Michael, is on one aspect, there's robust continuous software M&A happening, but on the other side, um, Dan, you indicate it's tougher to capitalize. So it's interesting where the investment market is looking at maybe we should either, find a way to monetize or de-risk our investment by fortifying it by partnering, with some other technology software company, and maybe that is better than capitalizing. And that's an interesting because businesses, especially early stage, do require capital, but you don't want to sell short. And the other one is earnout is, you know, as long as they're not capped, it certainly allows the shareholders of the team that built the company the opportunity to really say, great, we sold you something wonderful like Alacadia, and we'll take the upside because we know it's going to be there, right? So that's great. So, Kristine, what are your thoughts on what Dan and Michael have highlighted?
Yeah, I guess where my brain goes is, and I did some work with my former investor, Inovia, actually, they're a current investor in the new company too, sort of after the height of the big market. And I think what remains consistent though is that, and the banker who did our deal was also telling me this recently, there's transactions happening still for good companies, right? And we can define what good is. And we can go through that. But I think what was happening in the past is that some companies who weren't good, didn't have fundamentals, weren't really a good underlying business model, weren't delivering customer value, were still getting funded and still getting exits. And so to me, I look at what we can control. When you're a CEO founder, right? You have to think about what you can control. And there is a way to build a company, have the metrics, have the customer value, have the fundamentals that can result in the desired transaction that you want to do. And what has happened over, I think, the last few years is that sort of pulled the cover back on when people didn't have good fundamentals. And that's not necessarily a bad thing, right? That the market is sort of filtering out. And some of those companies have had to go do go de-risk and figure out what's next and just go maximize what they can. And that was probably a smart thing to do. And the others still have a lot of growth opportunity to go forward. So that's just sort of how I look at that. You have control in doing some successful outcomes.
Yeah, no, I think very, very important points. And once again, emphasize, leverage your strengths and build something solid and on fundamentals. In early COVID, certainly there was a rising tide that saved a lot of boats or helped a lot of boats, but that's good.
Sorry, just to add to that, it's Dan, a bit what you said about profitability, and that had a premium. We were cash positive, which was kind of unheard of at that time. We had a quick path to profitability. This wasn't unusual, but that was also very well received in the market even then. And so we sort of forget that there was still some companies who were spending way more than they were making, even in the height, that weren't well looked upon and didn't do the transactions that they wanted to do. So it's sort of this concept of those fundamentals really never go out of fashion. And you like Michael, like you were saying, things are going to continue to change. So control what you can control, and know that there's always ways to present, something solid to external parties. So sorry, George, and it was just to add to that.
But I love it. That was really relevant, and I bet I hope Mr. Patterson's watching because I think he would like it as well. Jimmy is certainly a fun focus on fundamentals, and and technology businesses that achieve that is great. If I shift a little bit, but really leveraging some of the points we've said, what do you think some of the factors that a company should consider and influence, for their exit, strategic partnerships, I'll call it, and how does that really vary by stage of company? And Dan, we'll throw it up for you, and then we'll go switch it to Kristine and Michael. But what do you think? By type of size and through various stages. What are your thoughts?
Yeah, absolutely. So I'll leave it to Michael and Kristine on some of the legal and operational metrics and kind of how to time that and what matters there. And maybe just come at this from a pure financial lens. So when we work with our clients, whether it's, assessing whether we're the right partner to work with them, or when we're, trying to time the market to some extent of, when our client will hit the right metrics and thresholds in order to be viewed positively by buyers in the market, we think about the 4 S's, which are scale, stickiness, speed, and sustainability. And there's sub-metrics within each of those. The benchmarks will vary, obviously, depending on where a company is at in its life. But just to give a few examples, so scale, I think, is very important. So that's measured by annual recurring revenue, ARR, and total revenue, if you have a mix of kind of professional services and implementation revenue as well. The key metric where you can run a very competitive process and bring a ton of strategics to the table, as well as a good mix of private equity folks, is US $5 million in ARR. Heuristically, that's just a threshold where people start to get excited that business could move the needle from a financial perspective. We do work with clients who are under that threshold but are growing quickly and have a path to breaking through that 5 million US ARR threshold. Stickiness, the number one metric that folks look at is net dollar retention, calculated on a cohort basis. So there's a number of different ways that you can slice and dice this. There's logo churn, there's gross dollar retention, net dollar retention. There's probably 5 or 6 different ways that you can calculate each of those. And so we always look at what is a software company with healthy underlying customer cohort economics, which we measure by a number of different KPI calculations. I call it in the stickiness category. Speed's an easy one. That's just ARR annual growth. You can look at monthly growth as well to show that your revenue growth rate is accelerating, or at least as you scale, staying consistent on a monthly or annual basis. And finally, sustainability, which really tracks back to, healthy growth margins. What is your EBITDA and cash flow margin? And how have you managed the trade-off between growth and profitability, which is measured in the Rule of 40. So for software companies, again, depending on the stage, those metrics and targets are going to vary a little bit, but I always think about scale, stickiness, speed, and sustainability.
Well said. And I will say, we might have a prize at the end of this for the people who can, just highlight those 4 S's again, but just, scale, stickiness, speed, and sustainability. And a lot of meat in that. Kristine, what are your thoughts on some of those metrics, and especially relevance to what you've experienced?
So 1,000% yes to Dan's metrics. This is something that, for example, Allocadia had good metrics across the board on those things. It makes your ability way more possible to do a transaction based on that. And I think the key there to me is that it's actually very counterintuitive when you might want to go through a process because things are going really well. So this is when people go, I could keep going, I could keep growing, I don't need to bring that in, I don't need to sell. And that's actually the exact time when you should be thinking about doing a transaction to affect the next stage of growth. Okay, selling is a transaction to affect the next stage of growth, either under a strategic or with a private equity that wants to keep growing you. This is the whole mindset of your business, is to accelerate through to that next phase in doing a transaction. What happens is, I think CEO founders start to go there when they're starting to run out of money and they need to sell. And of course, your metrics aren't there. I mean, this is kind of obvious, but what the not obvious part is it's going really well, you should consider it then, because this is the best time to craft your story, to craft the package, to say you're in growth mode. It changes the whole orientation to your conversation of why you're doing the transaction. And this is exactly what Allocated, and it was a very legitimate, we wanted the partner for the next stage to invest and put money in the balance sheet to go do this next innovation roadmap. And we had lots of different options at that transaction too. So there wasn't just one buyer at the table. Yeah.
Well, it's great. I mean, options are power, deadlines are weakness, and having that, ability to stand your own 2 feet and grow. Yeah. Once again, you build something that's substantial and it's a good company. you have options, and then that's leveraging that is really important. And Michael, you've probably seen that in transactions and some of the companies you've advised and partnered with.
Yeah, absolutely. And I yeah, just to pick up a couple of points Kristine made here and in her last comments as well, is, I think you need to be flexible on these things. You need to be thoughtful and mindful about your M&A process. And there's a lot of different reasons people might go into an M&A process. It could be coming from a position of strength, which you should be open to. You could be coming from a position of weakness because you need to. But if you're doing the things right and sort of controlling what you can control, as Kristine said earlier, you're going to set yourself up in the best position to be able to maximize that. And I to come at this from a sort of more legalistic perspective, if you're on your board, and for companies that don't have a sort of professionalized board with VCs involved, where they're sort of being forced to go through their rigors of quarterly board meetings, you still want to always keep this in mind as founders. As soon as you've got any angel investors in there or outside investors, you've got to be mindful of all this stuff and sort of thinking with your fiduciary hat on and going, what is our investor base look like? When are they expecting an exit, or when are they going to get, sort of a bit restless that we're dragging this process on? What are their expectations? What is my ability to raise capital over the next 12 months, 18 months look like? What does, our burn rate look like? And what does the market look like timing wise, on exits versus raising capital? But with all of that sort of in mind, and just kind of constantly thinking about, what is the best path? Should we be continuing to grow and go this alone? Should we be looking at M&A opportunities? If you've sort of built the fundamentals right and built strong strategic relationships, you're best positioned as a board to be able to pivot in the direction that you think you need to go in, right? Whether it's a hot market, timing, there's lots going on, and you might, have sort of an approach from a potential buyer, and you might not be planning to sell at all. But that's the point where you kind of go, well, are our metrics strong? Is the market hot? Is this the right time to do it from a position of strength? And if so, do I have relationships with other strategics that we've been cultivating for years that I should, can easily call up and say, hey, we've been approached. Are you interested? Before we sort of go down this path, because, again, you've got to carry out that fiduciary obligation to try and get the most for your investors. And, I've certainly seen situations where, clients, were exactly in that spot in 2021. And the ones who, were able to tap into a network of strategics that they had very close working relationships with, were able to get significantly higher multiples even even in that market, because they called up strategics that were willing to pay 200% more than the financial buyer was willing to pay, because of the strategic fit and because they'd known that team and knew how well that team would fit within their team. So having those relationships is just invaluable in terms of the flexibility it gives a board and management to be able to successfully execute on those sort of positive opportunities. On the flip side, if you're not able to raise, and you see that, hey, we're running out of time to get a deal done here, having those relationships in that situation as well is very helpful, because it gives you sort of options. Because the worst thing that can happen is you end up just sort of running out of money and I think heading into some insolvency process where you completely lose the ability to control the outcomes anymore, because it's with some trustee, right? So if you're able to still sort of have some control of that process and try and maximize that value, even if it's not from the peak of strength, you get out ahead of it early enough that you're still not at that place of desperation.
It's funny. It's like great commentary all the way around. It reminds me of when we got acquired, at Intrinsic in 2020, and candidly, my CEO, obviously, our CEO didn't want to do it. We had a unsolicited bid by another NASDAQ public company, and it was very, like you referred to, a strategic transaction that can really elevate the value because of synergies, but also risk mitigate. But we were doing very well. We had very rapid growth. We were strong, profitable, strong treasury, expanding, partnering with Qualcomm, doing some really innovative stuff and meaningful, financial performance and metrics. And, it was interesting. You sit back, it was a tough decision. 3 years later, the business had doubled that we put there, which was a great thing, because we built something of value. We knew we had some really good momentum and contracts, and it was there. So, but it's tough because there's that, when it's really going well, do you really want to,
That's
do
the
this? And that was,
counterintuitive.
and we thought about, do we leave money on the table? But we at least did a 50% cash, 50% shares. It's public, so we didn't do earn out. But at least with the 50% shares that carry really, and they bought us their shares for $3, and we were a key driver to them being $10, like 3 years, 2.5 years later, right? So, you can get there, but it's
Well, it
an
requires,
emotional and challenging decision, but that's a good problem to have, right?
well, it requires a crystal ball, and
Yeah,
you only know after the fact. And so
yeah,
Allocadia, we had a couple transactions early, and until the day I signed the transaction, I didn't know if it was a bad decision to have said no to those other offers that were very real up until that very moment. Actually, probably until the money was in the bank. So, and it plays on you, and you are sort of making bets. Can we continue to do more? Will things go well? Sometimes they do, and then sometimes they don't. That's why those decisions can be very emotional. And then, Michael, as you were saying, you also, as you kick off a process, you're sort of in the good, things are ahead. But then if something doesn't happen, then you've got the board around you. What's going on? Why haven't we done this? And maybe you've gone to market a bit. This is why I think as a CEO founder, those things are extremely difficult when you think about the practical reality of the steps you go through and sort of what do I say to my board? How do I start this? What exactly am I positioning here and wanting here? Because again, there's a couple different outcomes that could happen. And so you're sort of having to come to the table with that strategy, what you want, also knowing that there's some different ways it could end. And then if it goes badly, you're really in trouble. Like this is why these are extremely kind of stressful processes to go through. As a CEO and founder, they're unbelievable when they work out, but you kind of know it always doesn't work out as you're going through it.
well, and
So
Kristine,
it's
one
not
of the things
easy.
is, especially a lot of,
Yeah.
when you talk about the timing and when they want to consider, and sometimes it's out of your control because it could be unsolicited, an opportunity that evolves, but
Yeah.
it can be very distractful and impactful. And if you're really focused on building your business, your products, scaling, market share, then all of a sudden the shiny objects, which takes a lot of keep people's attention. You got to be careful to balance that. Certainly leverage outside resources like Dan and Michael to augment your team and support and mitigate and enhance value. But it's a balancing act, and on that sort of thought process, I'm going to keep it with you on this next one, Kristine, because I want to know lessons learned. What are the war stories? What are you thinking about that? Wow, that was great. And those moments which I've had, which is, whew, we took up through that or something like that. And, yeah, things that can come back that, that can, we can share with people.
Yeah, I mean, I think the main one that comes to mind is this concept that people talk less about it now, but this concept of, good companies are bought, not sold. I actually, in a way, disagree with that. So you have to have a good company, okay? You have to have fundamentals. But my big learning through our transaction and what I've just seen in general with other CEO founders is that you can go and craft and create that reality, right? You don't have to wait for someone to come in and initiate that. Like, sure, if someone is inbound, those two first acquisition offers we had on Allocated were inbound. They were very much someone coming to us. But this third one, and look, times have changed a little bit. So meaning the ability to craft something is a bit different, but there's a lot of private equity firms out there that do want to do deals, transaction with good companies. And to put yourself in the position where you can go and execute on that because you've got the right business model, the numbers, like Dan was saying, matters tremendously. It can take quarters to shape towards having some of those. And then for sure, looking at the external market, that was a lesson. That was a very like I knew that the external market was the way it was and that it wouldn't last. And so that timing, and because our numbers were also looking very good then, was like a very overt choice. It wasn't just waiting for something magically to happen to us. And it started with me preparing something that I was presenting to the board. And I had one board member who really helped shape how I communicated that strategy and story. Because I've never been through an exit. I don't know, this is why you have a good board and good partners, other, CEO founders around you that can help you try and understand how to shape and craft that. But anyways, that to me is one of my biggest lessons through that process.
Well, and it's fantastic, and it's got a lot of substance to it. And I know one of the things I was impressed with you highlight is it's you got to be in tune with your market, your opportunity, your ecosystem,
Totally.
and both from a risk
Totally.
and a threat perspective, but an opportunity. And
Yeah.
you had highlighted, and I'll throw it to you, is how you and your board, but you and your team always were aware of who the strategic players were
Yeah.
in your ecosystem. Maybe you
Yeah.
can elaborate a little bit of what you did, and because that not
Yeah.
only helped you as a business, but
Yeah.
also, putting seeds of some of the strategic
Yeah.
partners for potential,
Yeah.
partnerships and relationships.
Well, totally. And a lot of people talk about building relationship strategists. I actually see and this was sort of through my CEOs don't always spend the time to do that though. Like it actually takes specific steps and proactive work. And my mode, so we were in the marketing cloud space. So I would go to the heads of the marketing clouds at Oracle, IBM, SAP, Salesforce, like all the big ones. And the head of that, I would reach out and ask for 20 minutes to learn from them, hear what they're hearing in the market, share a bit about our joint customers and what they're experiencing. And I always got a yes to that. And a lot of that was oriented around the customers. And so that's why we don't often talk about the how part of building those relationships. Once you do that, you can get go-to-market benefits, right? To me, there was always an anchor on joint customers. To me, that's the best way to go build strategic relationships. It's got to be joint customer values. So orient from that. Who are our customers using both of our technologies, et cetera? And then go and learn and hear from those strategics on those specific customers, and you share those stories and what they're doing together. Then you can do some go-to-market, which is, of course, the real fundamental hook on building a strategic and having them at the table. And although we did a transaction, we had three term sheets and a couple following close behind, and one was the big strategic that we had always known we partnered with. They really liked, it was just the timing was off. I still think they didn't think that we were actually going to close on that transaction. They would have loved to do it. So we had options, right, as we were going. You never know which options are maybe going to play out in the end, but you have to create those options. So
Yeah, really meaningful advice and right and practices to go by. And why don't we go, Michael, what are your thoughts in terms of lessons learned you've seen almost there at the finish line, and maybe something comes up or anything else that you're thinking about?
Yeah, absolutely. I mean, I'm going to sort of tailor these a little bit for, I think, today's markets. And so, having been through a few phases of the economy where you've seen that some uncertainty out there, you sort of have to be ready for things to change quickly. And in an M&A deal, once you're sort of in the process, you're the company, you're spending money on advisors' fees. As you're going through this, you don't want to be halfway through a deal and have it fall apart because of some macroeconomic shift that causes the buyer not to want to complete the deal. So, these three things are really around things that can, again, going with the theme of controlling what you can control, or things that founders and management can control to make sure that there's no holdups or delays on deal timing on their end, so that once you're sort of in process, you can move through it as quickly as possible. And I would say with that, it's, one, obviously be clean on the due diligence side. Get everything fixed up ahead of time. You do not need due diligence issues coming up that, are going to cause the deal to move more slowly than it otherwise would. Just sort of be well aware of where the issues are, be out ahead of them, clean up as much as you can in advance, be organized and efficient so that that process goes as quickly as possible, and you don't give a buyer any reason to slow down the process for that reason.
Or haircuts.
Yeah, exactly. Or a haircut.
1000%.
Yeah,
Yeah.
exactly. I mean, even leaving that aside, or the deal falling apart. I mean, that stuff happens less, but delays are very common. So,
Yeah.
just anything you can do to kind of get out of your own way and make sure that that is clean and organized, and you're on top of that, is helpful. Two, I would say, pick the right advisors to work with who've been through this, who've been through these types of deals in various economic cycles, particularly advisors that are experienced doing Canada US cross-border deals, or cross-border deals generally. That is another place where I see sometimes delays, especially if there isn't good early communication involving sort of everybody on your advisory team sort of at the LOI stage. Is get the input in early, because if you're I see this come up often where Canadian startup might be working with financial advisors that are based in the US who will say, oh, we've done lots of Canadian deals, but they're not necessarily live to some of the cross-border tax issues that might come up, or structures that might need to be implemented. That can be sort of a fatal mistake from a timing perspective when your counsel's then coming in later and saying, hey, you guys are going to have tax
That's a
issues
big
on this.
factor.
We need to structure around this. We got to propose some, more structures. And suddenly you've got a buyer who's, was not aware any of this was going to be an issue. You're bringing this to them, and that is absolutely going to cause delays, and possibly price adjustments, or possibly them putting some burden for that extra work, back onto the sellers. So, again, you want to get out ahead of that stuff early. And a big part of that is having the right team and having a, clear, open lines of communication, and involving everybody in the process, transparently from an early stage. And then finally, the other one I see that comes up and causes huge headaches on deals is companies that don't do a good job sort of managing their investors. They've sort of ignored their investors for the last couple of years. Suddenly it's an exit, and they're reaching out, and they there's investors that aren't happy with them. There's investors they've lost touch with. Everything then becomes a bit more painful and slow to sort of work through while you're going out to get documents signed, or it creates some risk or nervousness. And buyers are very sensitive to those sorts of risks as well. So the second they start to feel that maybe you don't have everybody confidently locked up and willing to sign off on the deal, they can get quite nervous too. So having good investor relations, making sure you're keeping people up to date on where things are at, and managing their expectations for what an exit will look like. Like, that's the other big piece, is if it is sort of more of a distress type situation, and your investors don't know that that's the situation the company's in, they're not going to be happy when you bring that offer to the table with them. Whereas if they know the financial circumstance of the company, they know the challenges you've been facing over the last few years, they will see this coming and just be happy that management has sort of landed the aircraft, in some way that is, not harming them, right? And I've seen lots of cases where that's the case, and the investors have a completely different reaction to the founders. It may not be a huge successful exit, but if they're well informed and they see them sort of get the team to safety, they're super happy to partner with them on another deal in their next venture, in their next company. Investors on the other side who are caught off guard by that sort of thing, they are furious. They're furious. They often don't want to sign the deal papers. They don't want to talk to the founders. They won't talk to them, won't work with them in the future. And all it comes down to is communication, and sort of having that managed earlier in the process.
Well, and managing the speed bumps and mitigating them. But I think that was really, by the way, free, pragmatic, very important advice. So thank you, counselor, for that. I can attest, being a director of a public company, and we led a transaction private equity firm, SaaS-based software, and there was transfer pricing tax issues that came up in the 11th hour that was very challenging to navigate through, right? Because these things may not seem like big things initially, so including communications with investors, and there's always risks. And let me throw it to Dan there, because I know we're running a little short of time, but I do want to hear your comments. And once again, we're really honored to have such deep and experience and advice through from all these panel experts. So Dan?
Yeah, for sure. I'll keep it concise. I think the number one thing that I see that either slows deals down or kills deals, and it's much easier to say and quite challenging to execute, is just continued business performance and success.
Oh,
So you have
yes.
1,000 things going on growing your business. Throw in, 3-hour calls with me on due diligence and 4-hour calls with Michael on reps and warranties. It's so hard to keep everything straight in your head. The number one reason why, buyers want to push closing out by a month or a quarter, or frankly walk away, is because of the underlying performance and growth and success of the business begins to deteriorate. So your number one focus, although many hours of the day is going to be the deal, never forget about the business. That's how you're going to close the deal.
Just a little quick story on that maybe to close is it can derail a deal when it happens, like when you hit your number, it's the end of the quarter, you're going through the deal, you're proactively share that with your buyer, okay? Because it's the end of quarter. You should know as CEO where, don't wait for that. And I shared it with them. I'm like, oh, and by the way, in a call, we hit our number this quarter. Great, good. Okay, move on to next thing. Then it's quiet, it's nothing, but it was stressful to hit the number through the deal. It's like you said,
Well,
you're all here, and then you're
right?
here. But like, I was like, oh, thank goodness I could actually go do that.
But that'll flow
That's thanks to my team.
and that'll flow to due diligence, like credibility and negotiation, warranty and reps and trust, right? Going forward. And just in the last minute or so we have, I just thought I'd do quick any final comments from our panel to other than just good luck and look forward to everyone's success, because I'll take that one. But Kristine, do you want to start us off, or why don't we start with Dan and Michael? We'll leave Kristine for last. Because so Dan, any last comments or anything you wanted to augment?
Yeah, for sure. I think biggest piece of advice for Canadian founders is think big and shelve your humbleness, especially when you're speaking with US investors. Capital is competing across porous boundaries. The vast majority of capital pools of investors are in the US, and you're going to be competing against US founders who are shooting for the moon. I see Canadian entrepreneurs do this, unfortunately, all the time and shoot themselves in the foot to some extent. So I would say, first, know your audience if you're speaking to a US investor versus a Canadian investor. And when you're talking to Canadian or US investors, level things up, shoot for the moon, be extremely ambitious, be confident, demonstrate speed and credibility and a vision to really go and own the market.
Wow, I agree totally, and that's a high bar, but an important one for sure, right? So thank you, and I really do appreciate that, Michael.
Yeah, I would say it's know your market, know your place in it, and understand sort of the broader macroeconomic trends that are going on, and have a plan and a strategy around an exit, but be willing and flexible, and have set yourself up in a way that you're able to pivot as circumstances require, because that's sort of the name of the game, is you're going to have to pivot your strategy around what else is going on around you, and it really is just putting yourself in that position where through strength of relationships, strength of the business, and strength of the people around you and your team, you're able to sort of pivot and execute successfully regardless what the circumstances are.
No, well said and well thought out. Kristine.
I guess I'll go to the maybe motivation or mental side, or just pump up people on the phone, because I think as a CEO founder, you feel like going towards an outcome is the big dream. Let's be real. We start these tech companies to go through that process and grow and make an impact, and that it's possible. And I remember looking at some of these numbers and scenarios when we first started Allocadia and just saying, no, it's crazy. And our exit wasn't even the stuff I ever plunked into my models. And I still shake my head today at the fact that actually happened. And when it does happen, and I had good board advocates too who did this, we accelerated employee options, right? All employees had options. It's so great when you're on the other side to see the whole team benefit from it. And I always encourage other CEOs, it's a bit cheesy, a bit cliche, but this is very true, to do good equity for your team too, because when there's a lot of money to go around, you want those people that brought you there to do it. And it is a very nice and fun thing to go through. So just motivation, it's stressful, it's hard, it's crazy amount of work, it's up and down, it's binary at the end, but it is possible. That's it.
You know, I coach a lot of youth sports, mostly soccer, and
Yeah.
I just love what you just said because
Mhm.
it's teamwork, integrity, and
Mhm.
the captain is really part of the team, and a team wins. But I applaud your one for all for one because it's so empowering
Yeah.
and it's just good, and that shows it was a lot of it was you obviously in your team, but it's everyone around you, and
Yeah.
congratulations on your success there. That was really a beautiful way and an important way to end it off. And
Mhm.
Erica, I've learned a lot. I hope everyone else has. It's I really appreciate it. Having
Thank
such
you.
an experiences themed panel here, and I just really want to thank every one of you, and hope our audience did enjoy that as much as I did.